When you have strong or very high debt relative to liquidity, so a high or strong debt to liquidity ratio, which you can see on the chart is really well above the 200% dotted line there, you tend to find there are refinancing crises. And as you can see from the projection, what we show there, the orange line, that ratio is slated to not only just move up to the dotted line, the normal equilibrium, but actually shoots through it. And that's because there's a lot of debt coming back into the system now that was termed out during the COVID years that needs to be refinanced. And what's more, the growth rate of liquidity, particularly coming out of the Federal Reserve now, is slowing down quite noticeably. So we may be moving into an era of more repo or refinancing tensions.
When Michael Howell talks about debt and liquidity, he isn't giving you theory. He's describing the engine that powers every boom, every crisis, and every asset bubble of the last 30 years. In a recent interview, Howell lays out a reality that almost nobody in mainstream finance wants to admit. Markets rise and fall, not because of earnings, not because of valuations, but because of the balance between liquidity and the massive wall of global debt that constantly needs to be rolled over. When that balance is loose, assets melt up. When it tightens, things break. And right now, the world is quietly sliding back toward the most dangerous part of that cycle. For most of the last decade, policymakers flooded the system with cheap liquidity, slashed rates to zero, and extended the maturity of trillions of dollars in debt. That was the fuel for what Howell calls the everything bubble, a period where it felt like everything could go up forever because liquidity was limitless and refinancing pressure disappeared. But the moment that liquidity slows, the moment the orange line shoots back above equilibrium, the system flips from bubble mode into stress mode. And according to Howell's projections, that flip is already underway. This is the part most investors are totally unprepared for. Because while everyone focuses on GDP, earnings, and headlines, the real pressure point is much simpler. There is a tidal wave of old debt returning to the market at the exact same time liquidity creation is slowing. That is the formula for refinancing tension. And that is exactly what repo markets have been screaming for months. Howell is essentially warning that the calm we've been living in is not the new normal. It was the temporary peace before the next liquidity squeeze, and that sets the stage for everything happening right now. Because before you can understand where markets are headed, whether stocks continue higher, whether crypto breaks out, whether risk assets catch another wave, you have to understand where we are in the global liquidity cycle. That's what this video reveals. And trust me, once you see what Howell's model is signaling, you'll never look at the macro landscape the same way again. If you're new here, make sure you hit the like button, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for the support, and let's dive right in.
The financial markets no longer work in the way that sort of textbooks describe. I mean, you can look at the maths of how you discount a flow of earnings and why that's supposed to sort of drive an asset price. But in reality, it's very different from that because capital markets are no longer about raising money for new capital investments. They're much more about rolling over existing debts. And what we're sitting on in the world economy now is something like $350 trillion of debt of all stripes. Government debt, corporate debt, household debt, etc. And that debt is not infinite, and it doesn't last forever. It's got to be refinanced. And the role that financial markets increasingly take is they're basically debt refinancing mechanisms. And that debt has to be rolled. So if you've got an average 5-year maturity on a bond, and you've got $350 trillion of debt out there, you need to roll 70 trillion of debt every year. So that's a big, big ask, because it's basically what we're talking about. We're talking about 3/4 of world GDP being rolled in financial markets from debt transactions. And that requires balance sheet capacity. And that balance sheet capacity is what we think of as global liquidity. So that's really both the genesis and the definitions of what we're talking about.
How does global liquidity and debt factor into public markets of all types? Like how do you leverage that as a framework for informing investment decisions?
The first thing to say is that liquidity tends to be fungible. In other words, it moves and it can shift from place to place, particularly when you're outside of crises. In crises, liquidity tends not to move. It tends to be stuck. People, freezes, people sit on it, never, then don't move it. But generally it's fungible. So it will shift around. So if you have situations where there's too much liquidity in a financial system, what you'll basically start to see is that liquidity will go into, where the vent will probably be higher asset prices. If there's deficient liquidity, then you're going to see periods of financial crisis more likely. Now, we can probably show that this slide, which looks a little bit daunting because it's a schematic diagram and there's quite a lot of words on that. But let me just sort of focus on what this is really about and why it matters. And this is saying that if you look at the global financial system, really post GFC in 2008-9, what you've got at the heart of it is a debt refinancing system that has a debt liquidity nexus right in the center. And what that really means is that debt needs to be refinanced, and to refinance debt you need liquidity. But the paradox in the financial system is that liquidity is increasingly collateralized, and it requires existing debt as its backstop or its collateral. So you'll see written on in red lettering on the top left of this, 77% of global lending is now collateral based. Well, that's actually not our figure, that's a World Bank figure. And what it's saying is that, people can think of a very straightforward example like their home mortgage. Domestic real estate, if you've got a mortgage, is essentially a collateralized loan. But if you extend that out to financial markets, if hedge funds are borrowing to do something, let's say, called the basis trade, where they're effectively buying cash bonds and they're shorting futures, they will actually be borrowing from dealer banks, and they'll be using US Treasury bonds as their collateral. So they'll be borrowing against that. So most borrowing in financial markets is backed by collateral, and that collateral tends to be government bonds in some form. It may be bills, it may be notes, but whatever, it tends to be, it may be US Treasuries, maybe German bonds. But it tends to be basically some form of solid financial instrument. Now, that's at the heart of the system. And what you see are two wings here. One is on the right where it says refinancing. So that's turning liquidity into debt, helping to roll the debt over. And then you've got the other wing on the left, which is the repo collateral wing, which basically says that in order to get liquidity, you need debt. Now, either of those two sides can break down, but what tends to break down is the collateral repo side first. Now, just to show what this means, and I'll pause after this slide, because there's obviously a lot of ground to cover here. What this shows is the ratio between debt and liquidity in the world economy. Now, the big problem we've got as a society, as a Western economy, is there's just way too much debt in the system. And I know you guys have written about this in the past because I know I've read it and been very impressed with the analysis. But what this is basically illustrating is that what is really critical is the ratio between debt and liquidity, not necessarily debt and GDP. Debt to GDP just tends to trend up. This particular data series, debt to liquidity, is a stationary or sideways moving series that tends to see very clear cycles. When you have strong or very high debt relative to liquidity, so a high or strong debt to liquidity ratio, which you can see on the chart is really well above the 200% dotted line there, you tend to find there are refinancing crises. And what we've done is we've illustrated with the annotation where you get financial crises, and it tends to be when you've got an elevated or stretched debt to liquidity ratio. The counter side of that is that if you've got a very low debt to liquidity ratio, in other words, bucketfuls of liquidity, not much debt to refinance, you then tend to get asset bubbles. And that's what we've illustrated with the annotations on the bottom. Now, you'll see in that lower right-hand corner, what we've denoted there is the everything bubble. And the everything bubble is clearly what we've been through or experiencing right now, where the debt to liquidity ratio was very low. And that was because in the wake of the GFC and during the COVID crisis, policymakers just addressed the problem by throwing lots of liquidity into the system. And what's more, they slashed interest rates to near zero rates So you basically encourage a lot of refinancing or terming out of debt into the latter years of this decade. And as you can see from the projection, what we show there, the orange line, that ratio is slated to not only just move up to the dotted line, the normal equilibrium, but actually shoots through it. And that's because there's a lot of debt coming back into the system now that was termed out during the COVID years that needs to be refinanced. And what's more, the growth rate of liquidity, particularly coming out of the Federal Reserve now, is slowing down quite noticeably. So we may be moving into an era of more repo or refinancing tensions, which is exactly what the repo markets are currently telling us.
So what Howell just described isn't some abstract theory. It's the backbone of why markets behave the way they do. When he says financial markets aren't about capital formation anymore, he means it literally. They've become giant debt refinancing machines. With $350 trillion outstanding globally, the world has to roll the equivalent of 3/4 of global GDP every single year. That's why liquidity is everything. It's the oxygen of the entire system. When it's abundant, assets inflate. When it dries up, the refinancing machine stalls, collateral gets stressed, and the cracks show up fast. And this is exactly why the next chart matters so much. Howell isn't just presenting a cycle. He's showing the timing mechanism of the modern financial system. A 65-month liquidity cycle rooted in the average maturity of global debt. It bottomed almost perfectly in October 2022. It carried markets higher throughout 2023 and 2024. And now, right now, it's starting to inflect. Whether that inflection becomes the next leg up or the start of tightening pressure depends entirely on what central banks do next. And that's where Howell turns next. The Fed's liquidity injections.
First one is where are we now in the cycle? This chart here, which is really the centerpiece of what we do, is looking at the global liquidity cycle. This is for the advanced economies. So it's pretty much everything apart from China is in there, or China and emerging markets, but China is the dominant missing economy. And we've taken China out really because China is at the moment quite erratic in terms of its liquidity, which we can dig into later. But for the best part, this is showing the major advanced economies. Now, what this illustrates is a cycle that goes right back to the 1960s, and this is looking at the momentum, not the level. Let me stress the momentum of liquidity through world financial markets. Now, that cycle is a refinancing cycle, and what we've done is we've put on top of that a sine wave. Now, that sine wave we estimated using something called Fourier analysis back in year 2000, so 25 years ago, and we haven't altered the frequency of that since that time. So what you see is what you get, and it seems to be lining up pretty well with a 65-month cycle. Now, independently, an organization called the Foundation for the Study of Cycles contacted us earlier this year and said, could we have your data? Because we do a lot of very rigorous cyclical analysis, and we like to test out your claims that it's 65 months. And I said, yeah, sure, here's the data. Take a look at it. They came back and they said, well, lo and behold, we find exactly the same result. All our algorithms are pointing to the fact that there's a repeating 65-month cycle. So apart from the fact that's reassuring, real question is why? And I think the answer that I would give is that that's really the average tenor of global debt. So 65 months between 5 and 6 years is the average maturity length of debt in the world economy. So that, to me, sort of fundamentally suggests that this is a debt refinancing cycle, in the same way as if you sort of picked up a textbook, an economics textbook, maybe of 40, 50 years ago, they'd be talking about a capex cycle. And the capex cycle was really arose from the fact that the depreciation cycle of fixed investment was around 10 years. And that's what people thought was a 10-year decennial cycle. So now we've got a cycle which is between 5 and 6 years. It's not a capex cycle, it's a debt refinancing cycle. And what you can see with the latest data is that this bottomed almost exactly on cue in October of 2022. It's been rising ever since, but it's just inflecting now. Now, that inflection may be a meaningful one. I mean, clearly, if you look at the data historically, I mean, there have been false dawns, so it's possible it goes up again. But the question is to try and understand what policymakers are doing. So the key one is really the US Federal Reserve. So let me turn to what the Fed is up to. This is the chart that we really need to look at, which is looking at the growth rate of Fed liquidity, which is answering your second question about what is the Federal Reserve really doing with its balance sheet, or maybe more generally with interest rate policy. Now, let me start with the interest rate policy question. I think in a world where you've got huge amounts of government debt and where the government is making significant transfer payments into the private sector, it's very unclear to me whether higher interest rates or lower interest rates are stimulatory or not. I think it's a really grey area. So in other words, if you're doing a lot of transfer payments from the government and the Federal Reserve decides to cut interest rates, you're actually slowing down transfer payments, and that is a loss of income, and that should actually be, for a large part of the economy, actually an economic drag because you've got lower income. And the fact that you're not borrowing money from the banking system for your capex means there's no offsetting benefit from lower rates. Most investment these days is either government induced vis China, or it comes out of cash flow. So that would suggest that maybe interest rates are not necessarily the key variable. And what you need to look at is really the amount of liquidity that policymakers are actually injecting into financial markets. And what this is showing is the liquidity injections of the Federal Reserve. Now, that's not the balance sheet, because every item on the balance sheet is not necessarily liquidity creating. There are elements which subtract liquidity. There are elements that don't create any liquidity. So what we've done here is just to extract the liquidity creating parts, the net liquidity creating parts of the balance sheet. And this is showing the gyrations in that particular element. Now, let me just get a little bit more granular without straying into the weeds too much. That is things like looking at what you might call Fed credit. So it's things like open market operations, traditional ones, buying debt, for example, or things like the Bank Term Funding Program, which was giving emergency assistance to the banks. It could be discount window lending, etc. So those are forms of Fed credit that go into the system. And subtracting from that would be things like security issuance by the Fed that absorb liquidity. We'll think of that as a reverse repo program. Or think of as well the Treasury General Account, which is a balance that the US government keeps at the Federal Reserve, which is, if you like, a sort of a deposit account that it can build up or run down. And if it builds up that TGA, Treasury General Account, it's taking money out of money markets. So what you've got to look at is not the overall balance sheet, which would be distorted by all those elements, but only looking at the liquidity creating parts. And that's what we show here. Now, from over 80% growth in 2021, at the peak, this is 6-month annualized, we were right down at negative 40% by early 2022. And then the cycle began to turn by the end of the year, and you started to go back to positive liquidity growth in the Fed. It's wobbled a couple of times since, but certainly around the beginning of 25, largely because of the debt ceiling impasse, and then more recently the government closed down, you've actually seen liquidity go back into the markets. And basically, sorry, I said the government closed down, I meant that was actually a negative. And now what you've seen is the rebuild of the TGA and the government close down has caused that withdrawal of liquidity sort of up until that sort of grey forecast period that we've got there. So effectively, Fed liquidity is negative.
But you're projecting that it will start to go up based on this chart?
Yes, I'm predicting it's going to go up. It's not going to go up very much, but it's going to go up. And the reason it goes up is that we've factored in here $250 billion, in other words, $20 billion a month of QE, not just the end of QT, but actually a positive QE. Now, I think the Fed is gearing itself up to doing that.
Howell's insightful analysis reveals something almost everyone misses. It's not interest rates that drive the cycle. It's the actual flow of liquidity the Fed pumps into the plumbing of the financial system. Rate cuts and hikes are blunt tools, but liquidity injections are the real transmission mechanism. And when you strip out the non-liquidity elements from the Fed's balance sheet, the picture becomes brutally clear. The pace of liquidity creation is slowing, and the pressure from upcoming refinancing needs is accelerating. That's the collision path he's warning about. In a world with massive government transfer payments, huge fiscal deficits, and record-level debt maturities, Higher or lower rates don't behave the way textbooks say they should. If anything, cuts can reduce income for the households and institutions receiving interest. That flips the old logic upside down. This is exactly why Howell argues that liquidity is the only variable that still consistently explains asset prices. When the Fed expands credit, through open market operations, emergency bank funding, or its discount window, markets breathe. When it doesn't, they choke. This is what makes the coming months so critical. The liquidity cycle has already turned over at the bottom. Momentum has been rising for almost 2 years, but that upward slope is fragile, and the Fed's next decision will determine whether this becomes a sustained risk asset surge or a sharp liquidity air pocket. And that's the real takeaway from Howell's analysis. Markets are entering the most important phase of the debt liquidity cycle since 2008. The everything bubble is behind us, the refinancing wall is ahead of us, and liquidity momentum is sitting right at the hinge point. Smart investors aren't watching earnings or headlines. They're watching liquidity because that's what will decide whether the next move is a melt-up or a shakeout. If you found this breakdown valuable, hit like, drop a comment on where you think we are in the liquidity cycle, and make sure you're subscribed. This is the data that separates speculation from strategy, and we're just getting started. Thanks for watching, and see you in the next one.